In server farms across the globe, artificial intelligence systems are analyzing trillions of data points and discovering market trends that professional investors will not discover for days, weeks, or even months. This is happening right now, and it is fundamentally reshaping how markets move and who profits. The ability to predict stock market trends before humans do has always been the holy grail of investing, and artificial intelligence has finally cracked the code in ways that were previously impossible. The implications are staggering for markets and for the future of wealth creation. The market for AI-driven stock market prediction is exploding at an unprecedented rate. In 2024, the predictive artificial intelligence stock market sector was valued at approximately $253 million in the United States alone. By 2034, that market is projected to expand to nearly $1.2 trillion, representing an annual growth rate of 16.8%. This is not a niche corner of finance. This is becoming the primary infrastructure through which markets operate. Institutional investors now account for 52.3% of the market share for AI prediction tools, with algorithmic trading leading the way at 36.2% of application volume. The world's largest financial institutions are betting hundreds of billions of dollars that artificial intelligence can predict market movements better than traditional analysis ever could. The fundamental advantage artificial intelligence brings to market prediction is not just speed, it is perception itself. An AI system analyzing stock market trends processes hundreds of variables, simultaneously historical price patterns, trading volume data, economic indicators, earnings reports, sentiment from news articles and social media, satellite imagery of parking lots showing consumer activity, shipping data revealing supply chain patterns, and countless other signals that human analysts would never think. When a neural network analyzes thousands of companies simultaneously and identifies that correlate with future price movements, it is operating on a completely different plane from human research, deep learning architectures, discovering hidden market physics. The sophistication of modern market prediction systems extends far beyond sentiment analysis into deep learning architectures that approach artificial market prediction as a form of physics. Deep neural networks, long short-term memory systems, convolutional neural networks, and transformer architectures are all being deployed to identify patterns in financial time series data. These systems do not follow predefined rules. Instead, they learn the relationship between input variables and future stock movements through exposure to billions of historical data points. I know first exemplifies this approach. The platform uses proprietary deep learning algorithms trained on decades of market data to generate stock market forecasts. The system achieved an 88% accuracy rate on S&P 500 predictions and demonstrated that in 2024, their AI technology beat the S&P 500 by 73.85% on technology stocks. Over the 5-year period from 2020 to 2024, their algorithmic signals generated average annual returns of 27.4%, dramatically outperforming traditional hedge fund returns and passive index performance. What makes these systems powerful is their ability to identify non-linear relationships that traditional statistical models cannot see. A traditional regression model might identify a linear relationship where higher earnings growth correlates with higher stock prices. A deep neural network discovers that the relationship changes based on market conditions, the broader economic cycle, industry dynamics, and dozens of other variables that interact in complex ways. This adaptive learning allows AI systems to modify their predictions as market conditions shift. Hybrid prediction models have become increasingly prominent because they integrate multiple learning techniques simultaneously. Some systems combine LSTM networks that excel at capturing sequential patterns with CNN architectures that identify spatial patterns in market data. Others integrate transformer models that can attend to long-range dependencies with traditional statistical methods that ensure the system does not overfit to noise. The philosophy behind these hybrid approaches is that different types of patterns require different analytical lenses, and the most powerful insights emerge when you apply multiple lenses simultaneously. AI cannot predict crashes. Despite all this capability, honest researchers acknowledge a critical limitation: artificial intelligence cannot reliably predict market crashes or black swan events. Laura Song, head of quantitative research at Citadel, captured this reality perfectly when she stated that predicting market crashes with AI is like trying to predict earthquakes, theoretically possible but devilishly difficult in practice. The reason is fundamental. Crashes represent deviations from historical patterns so extreme that AI training data contains few examples to learn from. By definition, a 1 in 100-year event does not appear often enough in historical data for even the most sophisticated neural networks. Market crashes are often triggered by unexpected external events, geopolitical shocks, natural disasters, policy surprises, or sudden shifts in global sentiment that are inherently unpredictable. An AI system trained on market data cannot predict that a black swan event will occur. What it can do is identify when market conditions are becoming increasingly fragile and when unexpected events are more likely to trigger sharp declines. This represents early warning capability, but it is not prediction in the classic sense. When AI finds the edge, despite limitations on crash prediction, AI excels at identifying incremental trading advantages that compound into substantial outperformance. QuantConnect, a platform for developing and backtesting algorithmic trading strategies, partnered with TradeStation Securities to allow users to design, backtest, and deploy AI-powered trading algorithms. Their most successful traders using this platform generated returns of 27.4% annually, placing them in the top 1% of investors. StockHero deployed an automated trading bot using predictive logic to identify short-term trading opportunities. The system achieved a 76% win rate on day trading signals during 2023 and 2024, dramatically outperforming the 30 to 40% success rate typical of human day traders. While 76% accuracy does not guarantee profits when accounting for risk management and position sizing, it represents a massive improvement over the alternative. Research combining large language models like ChatGPT with traditional machine learning demonstrated remarkable results. When researchers tested fundamental analysis combined with LLM, generated insights on NASDAQ 100 stocks from 2020 to 2025, they achieved cumulative returns of 1,978% with monthly rebalancing, dramatically outperforming traditional buy and hold approaches. How markets will transform, the trajectory is clear. Artificial intelligence is becoming the dominant form of market analysis and will drive an increasing percentage of trading volume in coming years. The firms that master the synthesis of multiple data sources, sentiment analysis, and deep learning architecture will discover alpha, excess returns above market benchmarks that other market participants miss. The institutions deploying the most sophisticated AI tools will gradually accumulate market share as their superior performance attracts institutional capital. However, the market will adapt. As artificial intelligence becomes ubiquitous, many of the patterns disappear. The system that discovered a profitable edge one year may find that edge has evaporated the next year because other institutions have recognized and incorporated the same pattern. This creates an arms race where institutions must continuously invest in more sophisticated AI systems to maintain their advantages. Only firms with substantial capital and technical talent can afford to stay at the frontier of this competition. The most profound impact of AI market prediction is not that it makes traditional analysts obsolete, it is that it democratizes access to sophisticated market analysis. Platforms like Carve-Out AlphaSense and Trade Ideas bring institutional-grade insights to individual investors who previously had no way to access this quality of analysis. This has the potential to level the playing field between large institutions and individual investors, though most maintain advantages through larger data sets and proprietary research. The future belongs to investors and institutions that understand how to interpret artificial intelligence recommendations, how to combine AI insights with human judgment, and how to adapt as markets evolve in response to increasingly sophisticated artificial intelligence.